Good afternoon or good morning, depending on where you're joining us from. My name is Ryan Evans with the Center for Agricultural Profitability at the University of Nebraska-Lincoln. And this is part of our regular webinar series coming to you on a special day, Friday today. Happy Friday. And these typically happen most Thursdays at the noon hour. And you can see there on your screen the web address for our center's webinar page, which is cap.unl.edu/webinars, and there you'll find a list of upcoming webinars. We'll get some more scheduled here in the coming week or so, and you can find about 4 years worth of archived recordings from past webinars. So scroll through there, and lots of helpful topics, and we're glad to be able to continue bringing this series, and really thank you for joining us today as we prepare to look at financial innovations in the area of accessing farmland and accessible equity in farmland. So I'm going to turn it over right now to the host of this. We're going to have a presentation and a conversation today. And to lead the way is Corey Walters. He's an associate professor in the Department of Agricultural Economics here at UNL with our Center for Ag Profitability. So Corey, take it away.
Thank you, Ryan. Thank you for the introduction. Yeah, agriculture continues to reap the benefits of financial innovation. And today we're going to hear a little bit about that. This is very interesting, what's starting to take place between the financial tools that are available and the problems in agriculture with this group in particular going after one of the common problems that we've all went through growing up with through family stories where we're land rich and cash poor. And so how can we access that capital to continue to enhance the probabilities of farm survival as we look to continue to expand? This group today is not being endorsed by the University of Nebraska. Rather, we're here to learn about how they're viewing the marketplace and how they've constructed a business model to help farmers and investors at the same time win. And it's very intriguing. And so I'm here today with Drew Miller at Fractal and Harrison Rogers at Fractal, and they are going to lead this off, and we'll have a great discussion. I think both of them have agreed that we are open to lots of questions, and we will handle those as we go through, because this is an extremely innovative way in thinking about how to access that equity in your land to where you could take other business decisions, accept those business decisions than where before it could be a lot more difficult. So with that, Harrison, I believe you're going first.
Thank you, Corey. My name is Harrison Rogers. I help lead I help lead marketing at Fractal. I'm joined by Drew Miller, who's one of our farmer engagement leads. He works with farmers daily to think through effectively how do you expand your operation, capitalize on new deals coming across your desk in now a low margin, high interest rate environment. Drew, would you mind introducing yourself?
Yeah. Hey, everybody. My name is Drew Miller. I'm actually the growth strategy lead here at Fractal, working on partnerships and land investment and farmer engagement. So really appreciate Corey and Ryan for having us on. Really appreciate the way the university promotes innovative ideas and content, and excited to have this informational conversation with you all. To kick it off, I want to talk briefly about sort of why we're here today. As you all know, and as you can see on the screen there, commodity agriculture is in a tightening interest rate environment, in a tightening margin environment. There's a need for new financial tools to essentially supplement the existing tools that you have access to today: debt, operating profits, etc. And we're really here to explain how Fractal, an equity capital tool, is one of the many tools in the toolkit that can essentially enable you to make investments happen in this tight margin environment. So with that, who is Fractal? We are an equity capital partner that is marrying that investor buying power with owner-operator decision-making, because we think that local farmers making local decisions are best positioned to manage ag land as an asset, but also to ensure, good rural community outcomes, economic outcomes, yield outcomes, agricultural outcomes, but also water quality, soil health outcomes as well. We're a growth tool, meaning that we're not a tool for everybody. We're an equity partner that really enables operators to make more purchases, make more investments, or do slightly larger investments during the year. And that means that we're really not a silver bullet across the table. And with that, we'll get into Fractal in a bit and sort of how it all works, but I'm going to pass it to Harrison to talk about what we're seeing in the markets today.
And Drew, you were just out here in Nebraska.
Yeah, I spent the week, met with about 7 or 8 different folks driving around central and southwestern Nebraska.
Even Kansas, I think, too, right?
Yep, went down to Topeka as well. So
okay,
pretty up to date on where everything's at this year.
Sweet.
So for the next 15 minutes, we're going to do 4 things. We're going to outline what we're seeing in the market today from a margin and interest rate perspective. From there, we're going to talk about how does that impact your balance sheet, income statement, and cash flow statement. And then from there, walk through what Fractal is, how it can work for you, and then walk you through an example. So let's start by simply looking at the UNL crop budgets for 2024. We're just frankly projecting tighter economic returns. When you look at the corn futures price for today, it's at $4.34 a bushel. In comparison to an irrigated corn budget across a range of tillage scenarios, we can just see that economic returns are getting tighter. Now, it's important to note this is not the cash impact in terms of growing on a given acre, but factoring in depreciation and amortization, just the returns that you're getting from your operations in the land are certainly getting that much tighter. From there, the cost of expansion or the cost of borrowing has increased drastically. I actually pulled this graphic from a webinar in October of 2023, where the Federal Reserve came out and basically said, big surprise, interest rates are going up both for real estate and operating loans, which is making it harder simply to service the debt and to operate your farm. So when we look at it from an ag lender perspective, Farm Credit and the Ag Bankers Association surveyed 400 bankers. And across 2023, they said their biggest concern for producers were liquidity, working capital, and then being able to bring in and cycle cash through your operation. At the same time, though, new deals don't stop coming across your desk. Landowners are aging, farmers are retiring, we're going through a massive generational transition, and we're seeing bigger and chunkier land sales really come up for market, both from a private and then a public auction perspective. So when we talk to farmers, we see huge risk and opportunity. In the next 10 years, 500 billion assets worth of farmland will come for sale. Will you have the opportunity to purchase that ground, or will you be playing catch up trying to manage an operation that, frankly, has a unsecure land base? So how do you continue to expand in a low margin and higher interest rate environment? We've talked to several financial consultants who really have this idea of a war chest. This is the strength of your balance sheet and the ability for that balance sheet to capitalize on new deals. And that war chest it's a 3-legged stool. One is your working capital, and that's the investable capital that you have on hand for a down payment to access the financing that you need. Then it's the equity to borrow against, which is effectively, how many long-term assets can you use to collateralize to access that new financing for new ground? And then your ability to service that debt over time. And that really comes from the cash flow of your operation and your ability to manage those interest payments. Corey, I'd be curious to hear from you, given that you've actually done a webinar on working capital. When you see this, what's your gut reaction here?
I love that you're bringing everything together and you're looking at a holistic approach to try to take advantages of those opportunities that hit you in any way possible, but not to get over leveraged as well.
100%. Managing that war chest and making sure you have a strong buffer is key.
And
And
it
so
reminds, it reminds me, I should have paid more attention to accounting class when I was in college, for all the college kids out there paying attention today.
Yeah. Shout out to that financial accounting professor that we all hated. So what happens in lower margin and in a higher interest rate environment? You know, basically the cash that you have coming into the business goes down. So we can expect to see some working capital impact. And then as interest rates increase, so does your debt service. So being able to cash flow that new debt becomes that much harder. At the same time, our land equity has actually increased. Simply looking at the UNL website, I think land statewide on average has increased about 14% just this last year. If you look at it since 2020, I think in some areas it's been upwards of 40%. So that means that you simply have more equity to borrow against. That doesn't mean marking your equity all the way up to market. There's definitely some buffer and some, conservativeness needed there, but this is, again, a tool in your toolbox. So within that framework, how does Fractal help you capitalize on new deals? It's really about going back, taking advantage of all of that new equity stored in your land. And so I'm going to pass the baton to Drew to kind of walk you through, again, what Fractal is, how it works, and how we work with farmers.
Awesome. Thanks, Harrison. So you have good deals coming across your desk. You can't quite capitalize everything that you see on the table. So how does Fractal help you make that happen when it is the right tool? So the way Fractal works, we come into a field that you own. You may have a big equity position on that field, an existing debt instrument or not. We come in and we invest as a minority investor in that field. We'll go up to 45% of the field's value and up to 80% combined with your debt instrument. The whole idea is you're using that extra equity to unlock a down payment for a new field, for a new loan on that new field, and essentially expand the business in a way that you wouldn't otherwise be able to. We also see folks developing land, so adding pivots, drilling new wells, buying irrigation rights. We've also seen folks installing tile, new storage units, whatever it might be. The whole idea here is you're really preserving your working capital position and still able to make that investment happen without letting that war chest get too lean. Next slide, please, Harrison. So how does Fractal structure that investment? The whole goal here is let's get that buying power from investors while leaving the farmer in control of the property and of the management decisions. So investors, we raise a blind pool. Investors get access to land appreciation in our investment. We charge a flexible annual premium that's dictated by the amount of soil health practices you're using. And then we have a 10-year commitment on the investor front. They're not allowed to back out. They are tied in. Their liquidity is tied up for 10 years. On the farmer front, farmer's going to control all management decisions. So we're not going to come in and say that a farmer has to farm a type of way. There's no title changes on the property. And as a farmer, you have the liquidity control to be able to buy us back out any year after year two. So there's a lot more flexibility for operators, given we know that you're going to best manage the asset, and we want you to stay in majority control of that property so that you do exactly that. Next slide, please, Harrison.
And Drew, just really quick, when you say discounted premiums for soil health practices, what do you mean there?
Yeah, so today, given the current interest rate environment, we have an annual premium on our investment that's 5.1%. If you are using cover crops, if you're doing no-till, if you've done it for 3+ years, if you've got grassed waterways, whatever it might be, you're able to get a discount or a premium for that soil health practice of 0.2%. So that could bring you down to as low as 3.5% for that investment. The reason we're able to do that is because we see across the board. Granted, you got to use the right practice on the right acre, and not every practice is meant for every field. But we see across the board that farms that are using these soil conservation practices and building that organic matter see better yield stability, and thus better revenue potential and revenue stability moving into the future. And our investors are willing to pay a discount essentially for those practices.
Awesome. Thanks, Drew.
Yeah, thanks for calling that out. So how is equity capital different than debt? I want to preface that we are a supplemental tool. We're not trying to compete with debt. We're really just an additional financial tool that can help you go out, make the investments you need to make, and potentially take on more debt where it's right. The difference in structure is that we're cash cheaper. So in the first 9 years until you buy us back out of our position, we're going to be a little bit better on the working capital position over that time. There's a symmetric risk. So we're only tied from an exposure perspective to this one field that we're investing in. And then from a risk perspective, we share in the downside as well. So after 10 years, if that property is depreciated, you essentially, as the farmer, get a really cheap cost of capital. And then, as I said, there's a limited exposure piece. We're only tied to that field, so we're not collateralizing across the business. So with that, going to pass it back to Harrison to talk through sort of a live example with some dummy numbers that we can plug in here.
Awesome. And Drew, I mean, you mentioned that you were in Nebraska this past week. Can you talk through how some farmers are thinking about using fractal capital?
Yeah, I think that's an important piece. So we've seen quite a few different use cases. We've got a couple of guys that are buying properties using a fractal investment to free up a down payment. A couple other operators are using fractal to pay down variable rate notes and get themselves into a better bracket at their bank so that they can get the cheapest cost of capital possible on their existing real estate. So I think it totally depends. And then we've got another one using fractal to buy irrigation rights, drill a well, and put in a new pivot.
Awesome. So for this example, we'll just focus on buying a quarter and think through kind of how to manage that down payment. So let's say you're looking to purchase 160 acres. It's valued at $7,500 an acre, so it's a $1.2 million field. You're looking to put down 40%, so close to $500,000, and access a new land loan valued at $720,000. It's a 30-year term at an 8% interest rate. And so two different scenarios. One is that you can eat into your working capital, put 40% down and access that debt that you need, or use 40% with fractal capital, essentially use your equity. What's the impact for both of these scenarios from a working capital perspective? With 40% cash down, again, you're putting that down payment of $480,000, and then you just have your interest and principal payment of roughly $64,000. So within that first year, the impact to your operation is north of $500,000. With fractal, again, you're tapping into your equity. So in this sense, there is no cash impact. You still have that debt payment, but then there's that fractal annual payment of roughly $27,000. So when we do like a apples to apples comparison, just from a cash perspective, this is a really good way of, again, preserving your war chest for the next deal and the deal after that, or being able to actually tackle a bigger deal, say Aunt Millie, a landlord selling 400 acres worth of land. This is a great way to actually tackle that size of a land deal. What's important to note here is that we actually bake our first annual premium for that first year into the initial capital deployed to your operation as capitalized equity. So there actually is no cash impact in the first year from a fractal perspective. Annual payments are then scheduled to start of the next crop year. So this $27,000 isn't due until March of 2026. So really, it's almost a 2-year impact of not having any cash out the door from a Fractal perspective. So I have a question here. Yes, this video will be available at the end. Thank you, Corey. So this is just a really illustrative example of, again, managing your working capital to capitalize on that new deal by tapping into your equity. So if this is of interest, please discuss with Drew. Find us online on our website. We have a number of resources from a variety of financial coaches in our blog and on our web presence, just discussing equity capital and how it can be used across a range of use cases. But with that, I know we have a ton of time left. We're happy to dig in and answer questions or certainly take comments.
I'm happy to start that off. Thank you very much, Harrison and Drew. My first question is kind of an overall one. So someone comes to you with wanting to access some equity, but let's say their financials on the farm are a little broke or some issues. Do you guys still engage, or do you turn them down, or where are you at on that scale?
Yeah, so it all depends on some of the metrics there of, the financial metrics of the business. We're typically looking at the same thing that a banker's looking at before they give out a loan. So we're looking at debt to asset ratios, debt service coverage ratios, all those types of metrics. So we'll underwrite an operation based off the need. But essentially, we do have some relatively strict guidelines simply because our investment success enables us to go out and get more dollars and deploy to more farmers, right? So we do have that fiduciary responsibility to both sides to make sure that we're meeting a solid investment there.
Excellent. We have a question here from Nate Wyatt. The exit after 10 years, will you renegotiate to a new contract or buy out? Great question.
Yeah, great question, Nate. We will do either. So we could actually just trigger a sale on the back end of that 30% of the property to a new investor or to a new, cash infusion from our blind pool, or we could do an appraisal after 10 years and do a buyout that way. So you have both options.
Tell us.
And to be clear,
yes.
I'm sorry, Corey. To be clear, the farmer has the option to buy out Fractal anytime after 2 years. So you don't have to wait all the way through to the 10-year term.
Yep.
Exactly. We have another one here from Bill. What methods do you use to value farmland annually? Independent appraisers, Fractal internal appraisers. A great question as well. Yeah, where's the fox at with the hen house?
Yeah, good question, Bill. So we actually use UNL's land index based off of your geography to do annual appreciation depreciation, because we believe, we can't game that, you can't game that. It's a fair, conservative, third-party approach that can allow us to cheaply adjust that value year over year, and then we'll do that third-party appraisal at year 10.
And if there's suppose some disagreement, what then? What's the process like?
We'll do a second appraisal, and if there's still disagreement, we'll do a third, and we'll take the average of the three. So that's all in the contract as well.
Awesome. Tell us a little bit about your investors. You see you have some listed on your group there that look like some big capital folks.
Yeah, Harrison, you want to take this one?
Yeah, certainly. Our head of investor relations is calling a number of family offices, institutional investors, to really pull together capital. But the whole idea is that one investor isn't aligned with one farmer. It's many investors to many farmers. And the whole idea is that investors frankly don't know how to invest in farmland. Two, they really should have no say in how a field is managed, and really they're interested in really the impact, both environmental, social, but also the financial returns of being able to enable owner operators to go out and actually own the land that they farm. I think there's been a lot of pushback from what I'd call the Bill Gates model of farmland investing, where you go out and buy the land and then simply find a tenant to rent it back. I think that not surprisingly, there are investors who may not understand what's going on in rural communities, but believe that over the next 10 years with the generational transition, land should be in the hand of farmers, not investors.
So if I was just to follow up, because we've got some more questions there, but so if I wanted to be an investor, how would I go find you guys?
A great question. Well, I mean, they can find us online. We're getting a ton of word of mouth. We have a whole team really going out and kind of, again, seeking these, family offices on both coasts and then within the greater Midwest. So you can find us on LinkedIn, you can find us online, and then you simply type in a form and we'll call you.
Okay, good. No, but for me to invest money into your pool, that's what I was referring to.
Yeah, 100%.
Okay.
Find us online, and our head of investor relations will give you a call, and we can sit down and.
Good. You never know which way this could go. Okay.
Yeah, certainly.
We got another one here. Does Fractal get any rent beyond the 5.6%?
Nope, that's it. Yeah, so we get that 5.6% share in that annual payment.
And then every soil health preferred practice that they do, it goes down. You said 2/10 each time.
2/10 each time. Yep, exactly.
Okay, excellent. Another question: what could be the general time frame to get all of this in place?
Generally speaking, it depends on our underwriting queue. Right now, we have a pretty solid queue going into planting. It takes about 6 to 8 weeks to get evaluation done. So for us to make that offer on a field, and then depending on how quickly you're sharing your financial info with us, we could probably deploy capital in 8 to 10 weeks, or as long as 10 to 12 if you wait for the financials after you see the valuation.
Awesome. Another question here. Can this be used only for down payments on new purchases, or can we increase our working capital in this current commodity downturn?
Yeah, so we tell people that you don't want to be using this to buy a Corvette or a boat, but essentially you can use fractal capital on anything in the business. So we're not here to say you can or can't use it for any one particular thing. If you want to put together a better working capital position to weather a difficult time without selling any property, Fractal could be a good solution to do that with those minority positions.
Excellent.
And so, Corey, just one call out.
Yeah.
There's been a conversation around like timelines and usage. The conversations that we've been having with farmers is that Fractal really is dry powder in your back pocket for that new deal or that big thing to come up. We have seen farmers strengthening their balance sheet by just increasing their liquidity with Fractal in anticipation of a downturn. And frankly, right now we are, somewhat capital constrained, and that we just have a ton of farmer demand. So I'd encourage you, if this is of interest, and I'm really not trying to be salesy, have a conversation with us sooner rather than later, just so that you can get your feet wet, your sea legs under you to understand kind of what we offer and what's available to you, so that when the time does come, you are prepared and you have access to capital. Unfortunately, we've had to turn away farmers who've called us saying, I have a land deal in 2 weeks. Can you help me out? And that's just simply not enough time. So again, something to think about, and happy to take your call.
That leads me to the most recent question. I'll come back up from that. So if you were thinking about anticipation of property becoming available, can all this be done and put in the file to speed up the time frame ahead of time?
Drew, do you want to take that one, or shall I?
Go for it.
The short answer is yes. In fact, we actually had a farmer from, I believe it was Iowa, who basically said, I'd like to see how much Fractal capital is available to me, and I like to proactively go and talk to my landlords about their transition. So if you do have an opportunity that you think is coming down the road, reach out to us early, seek, our investment offer, see what capital you have available. If it works and you think this works for your operation, think of this as another tool in your toolbox. If not, no sweat, call us when you need us.
How many acres are you guys invested in now, or can you give us a range? I don't know if you give us your inside info there. How much in the Midwest? How much in California?
Yeah, so we're all in the Midwest. We actually don't invest on the coasts. We stay away, generally speaking, from specialty markets, unless it's a specialty Midwestern row crop. Then we'll make some exceptions. I don't have a good acre number for you today, but we've deployed, by the end of this week here, we're going to have deployed about $3.5 million, $5 million by the end of March. And we've probably done 5 or 6 deals today. So we started deploying capital back in the summer of 2023.
Awesome. Is the 5.6% set for the full 10 years?
It is, yeah. So it's not a floating rate. The only thing you can do to bring that down or bring it back up is the practices you're using.
And just to be clear, that's 5.6 of the current value of the land that's set by the UNL Land Index. So the actual bottom line cash number will change because it's 5.6% of a value that may go up or go down. And so that's where that symmetric risk comes from. If land values depreciate, so does your annual payment. So if you're expecting land to, hold steady or slightly appreciate, this may be a great way to mitigate that risk.
And if it goes down?
Yep, Fractal shares in that risk.
One other question here. Could you explain on the call how buying land in the amount of 160 acres and 120 acres would work? An actual example, we have additional land but don't have the cash.
Yeah, Harrison, can you hop back to the slide with the example field?
Second here.
Maybe go to the one earlier that shows our equity position. Yeah.
There you go.
So Tara, great question. If you have a couple of fields that you're looking to purchase, maybe you're going to finance one completely with debt, or maybe you need a down payment from Fractal with both. You would take fields that you already own in your operation. Fractal would come in and invest alongside you in those fields to free up the capital to use as down payments in those new fields to get additional debt from there. So a little bit of a alleviation on working capital, and something that allows you to get that buying power to still make those two purchases happen if they're must-have farms or land you're already renting that you need to preserve or something like that.
And so for those really curious of the instrument, how it works, and how you could use your equity, there's really 2 things that we do with farmers. First is just have an intro call, 1 to introduce ourselves, 2 to hear about your pain points, and then 3 just understand your equity position. If if we believe there is a fit, then we'll really sit for what we call an economic model review, in which we'll walk through an Excel spreadsheet, the cash flows of a given opportunity, and frankly, the cost of Fractal capital. So after those 2 phone calls, you should be well versed in really how this instrument could work for your operation. And we encourage you to take this, to your CFO and lender, just to talk about how this could work within your overall toolbox.
Awesome. Any other questions? I'll give everyone a few minutes or a few seconds. Well, maybe someone's typing. I find the innovation very enlightening. I enjoy the creativity that's coming up between the investment side and the problems farmers face. So it's very, very intriguing. And Ryan here is hitting me up on something. Did you see the Q&A? Aha, I left
Yeah,
one out. Thank you, Ryan. Let's see here. I had to step away, sorry, but does the annual premium pay down the investment at all, or is it just a premium, leaving the full investment amount due at the end of the 10 years?
it is just a premium, so it is not paying down that initial fractal investment. I see the partial pay down piece of that question. We do not currently offer partial pay downs for our product. That said, if you did pay it down partially, if our equity position was reducing, that would adjust the annual premium payment because that's multiplied by our position.
Excellent. Are you guys getting any carbon credit payments based on the practices that's happening?
We are not. So you're able to pick up any carbon credit payments, any tax credits, any EQIP payments, water quality credits, anything that's out there. We're simply adding to that pie with a discount on capital.
Excellent.
So the beautiful thing here is, again, we are not a carbon program. There's no additionality. There's no permanence. There's very minimal data collection just to verify you're doing these practices. But we're just connecting practices to cost of capital because we believe more stable yields should reduce a farmer's cost of capital because there's just inherently less risk on that field.
Awesome. There's a company that, because you guys aren't the only ones in this space, that requires an investor fee. My understanding is that Fractal does not have an investor fee.
Correct. There's no fee to the farmer for our land investment. We do charge management and origination fees to the investors.
Is the premium payment tax deductible as rent, interest?
We cannot give tax advice. So I would talk with your tax consultant. Generally speaking, it's seen as an expense.
And that's the same question from Nate here in the 5.6. Is it deductible? Another one over in the question and answer. How does this differ from a cash out refinance with a traditional bank? Fantastic.
Yeah, Harrison, go ahead and hop back to the debt slide, if you don't mind. So the difference between Fractal and a cash out refinance is that our annual premiums are going to be different. We are also locked in from a risk perspective, and we're not collateralizing across the business. So those are the three main things that you're going to see. We're really going to be used to take out additional debt, so not trying to compete in that respect. But that's essentially the different nature, different structure of our instrument.
Yeah, and just to add to that, with Fractal, there is no principal or interest payment. So I guess that's just fundamentally how we're different than debt. We always tell farmers, if you have access to cheap debt, please use debt every single time. What we found is that for farmers looking to tap into their equity while at the same time reducing the risk, to go out and access the debt they need to grow their business, this is where Fractal can really be a strong use case. I mean, at the end of the day, I think an Iowa farmer actually really said it best. He's like, Fractal has a given cost of capital, and I am betting that taking this cash out of my land and putting it back into my business will grow faster than just keeping that cash stored in my land. So if you need cash, whether that's to solidify your working capital buffer or go out and capitalize on new deals and grow your business, this tool is for you.
Yeah, and Dan, you brought up another great point there in your next question. Do we file a junior lien position on the fields that we invest in? Yes. So we are a second lien to the bank on any existing debt. So something to think about. That was a crucial detail that we overlooked here, but we are a second position to the bank.
If a bank's involved on that land.
Correct. Yep.
Fantastic. Any other questions?
Yeah, Drew, how many qualifying practices are there from a soil health perspective?
Yeah, there are 8 different practices. Let me see if I can get them off the top of my head. So cover crops, no-till, strip till. If you sustain either of those 3 practices, you get a discount. If you are not applying fall nitrogen, so in-season nitrogen, if you have grass waterways, riparian buffers, um, and then if you're willing to get up and share about your experience with those practices in front of a group, we'll give a discount for that. And then if you're introducing new crops to rotation, not as common in Nebraska, but we've seen some folks relay cropping wheat, you could get a discount for something like that as well.
Awesome.
There's a question on defaulting on your payments. Will the farm be sold? I guess, Drew, can you walk through the flexibility in default scenarios?
Yeah, so one of the things that's unique in our instrument is you can pay with equity. So if we take a 30% position and you're cash tight for a couple of years, you can pay us for 2 or 3 years with equity. The only caveat to that is that if you get over 49% on that property, that will trigger a default. So if you get over 49%, what we're going to do is we're going to come to you. We're going to say, hey, how do we get back under this 49% mark? Because in our contract, we can't legally be owners of that property. If we're unable to get back below that 49%, then we would trigger a sale on that property. We don't eat into your position at that point. We make away with our percentage of the property, and you make away with your percentage of the property. So we don't seize the whole property value. And that's worst case scenario. Hasn't happened to us yet. We don't want to get there if we can avoid it.
Excellent. Where do you guys see yourselves in a couple of years?
Harrison,
Are
I'll let
you
you
gonna take that
I'll let
one,
you
or-
tackle that. I can take it. So where do we see ourselves in a couple of years? The goal this year is to have deployed over $30 million in capital so that we can get access to cheaper cost of capital, bigger funds, think pension funds, teachers funds, all sorts of stuff like that, and bring down that cost of capital for farmers, go out and deploy more capital, and essentially be that investment partner that really reaches scale and is able to work with a variety of folks, have multiple products that can sort of fit different needs on the farm, and enable owner operator growth. So partnering with good farms to ensure that owner operators are continuing to manage and own farmland in the US.
You guys think you'll go broke?
Harrison, I'll let you're the
That's a
finance guy
question.
here.
What happens if you go out of business?
Yeah. The bottom line is that effectively the contract lives on. So Fractal, think of Fractal as a general partner of a larger fund. If the general partner was to step away, all of the limited partners, so all of that pool of investors, would effectively be tied to that contract, and then they would find a way to manage that contract. So basically, contract lives on. Someone will manage it, and really that is the continuity within all of this.
Do you update your lien each year to reflect the market value?
So our second lien is on a percentage of the property. So say we come in at 30%, we're taking those UNL appreciation, depreciation numbers every year to update the value of the property. So our position is going to stay the same, but our value is going to go up and down with the market.
So do you update the lien then every year on values, or is it listed as a percent?
It's listed as a percent.
Bingo. Okay.
Thanks for clarifying that.
So make sure. Can you put solar panels or wind turbines on it? Or can I not develop if Fractal has a share?
If we're invested in a property, it is in the contract that you cannot do solar or wind on that field. So we would just say, let's pick another field for the time being. I think as we get more mature as a company, we can start to take on projects like that. but it's simply just too much for us to really bake in from an underwriting and valuation perspective when investing in fields.
Okay. Excellent. It looks like we already have someone asking for your phone number.
Yeah, Harrison, can you go back to that last slide there?
Certainly.
So there's my cell number. If you're a student with questions, feel free to give me a call, text, whatever works. If you're a farmer that wants to learn more, same thing. And then you can scan the QR code there if you want to check out our website and fill out your information there as well. So pick your poison.
Awesome. Well, with that, I think we'll wrap this up. Ryan, I think you had a couple closing comments. And before Ryan jumps on, you guys, I'd like to thank you for coming on and discussing the innovation in accessing farmland equity to help farmers achieve their goals. And I like the connection to the environment, to investors, and how you guys have put all this together. And I'm excited to see where it goes and what else the market brings. And it reminds me as well that as someone in ag, we have to up our financial knowledge as well, because the playing field is getting more complicated, and we have to become more savvy as well to navigate this, because the game is at the financial side, not at just planting corn or soybeans. It's there.
Yeah. Thank you to Corey and Ryan for having us on. Appreciate it.
Yeah, thank you. Appreciate the time.
Thank you, Drew. Thank you, Harrison from Fractal. Great presentation today. And thank you to Dr. Corey Walters, professor here in the Agricultural Economics Department at UNL, for leading that. And most of all, thank you for joining us today on another Center for Agricultural Profitability webinar. As we mentioned in the chat earlier, you will be able to find this recording in the archive section of our webinar page at cap.unl.edu. And hopefully we'll get that up here later today, actually. And as you close out, you'll be presented with a very short survey. We would love to have your feedback on how today's webinar went and any ideas you have for webinars we might be able to bring you in the future. So with that, thank you again to Drew, Harrison, Corey, everybody for attending, and I hope you have a great weekend.
Thank you, Ryan.
Thanks, everybody.
Thanks, guys.